Hello, good people. Emmanuel Sanyu Safali bringing you the last episode of the historical narrative, the origin story of the insurance and reinsurance story globally. Now, I need to remind you that we discussed about the birth of modern insurance, right from the time of gambling, let me say, to probability theories. And then the second episode, we watched how the global expansion changed the way insurance was changing. And then also we had the story of Swiss Re itself. Then the third episode, we watched how, or we listened in to how the money matters changed after World War I. And then World War II came in, and we saw the dynamics there. Then there were also booming economy after the war. Now, in today's episode, we want to discuss the more money matters that happened after World War II and the booming economy. Then we should also look at a poor start to the 21st century, how things changed over time. We shall also look at the natural calamities or natural catastrophes and how they changed the way insurance was playing out. And that one was a whole different ball game, and insurance learned a big lesson over that time. Then lastly, we shall look at the general outlook as we conclude this channel. Remember, we have been celebrating 60 years of independence. We have heard a lot about how we transformed or transitioned from colonialism to self-independence. And also, insurance talks about how we started right from the time of people gambling or just forming solidarities. They use now mathematics and now mortality tables. We have changed, but of course also we don't operate in a vacuum. There are other factors that come in, like the wars, World War I, World War II. Then there's natural calamities or natural catastrophes, the earthquakes. So let's now listen in to how these more money matters affected the whole insurance space. During the 1960s, countries increasingly held more US dollars than the US could back with its gold reserves. In 1971, Richard Nixon took the US currency off the gold standard and initiated the demise of the Bretton Woods system, which supported the stability of global currencies. Capital markets were quick to adapt to the new risks posed by the fluctuating exchange rates and inflation. Over-the-counter derivatives were used to hedge against such risks, and even reinsurance futures were suggested as early as 1973. The oil crises of 1973 and 1979 upset international markets further and gave rise to neoliberal politics. This ensuing deregulation of the markets was to change the insurance landscape once again. Markets and companies not prepared to change were slowly overwhelmed by foreign investments and eventually taken over. Even the London market was forced to wake up when the US management styles were introduced and large German insurers started buying British companies. Mergers and acquisitions of long-standing insurance companies became the norm in the late 1980s and continued into the late 1990s. While most takeovers occurred within the industry, some banks and reinsurers began joining forces and prepared for the comprehensive financial services model, which would include banking and pensions and sometimes also property insurance. Large conglomerates appeared on the US market, where the gradual separation of commercial and investment banking opened new market opportunities. Investment bankers and insurers, pension fund managers, and security traders were in some cases now all working under one roof. The question remained whether they were really working together. The most successful part of this all finance trend
was to use banks as distribution channels for insurance products. Most other business lines were kept separate. And we are just trying to see this emerging in African countries in the early 2000, from early 2000, maybe 1918. That is when we saw bank assurance also open up here in Uganda and in other African countries. And these were things that were done in the 1980s and 90s. But now we are seeing how it's progressing. One more way, however, led to successful cross-fertilization. Large hurricanes such as Andrew in 1992 highlighted the need for more capacity to handle natural catastrophes. Swiss Re took the lead in developing new products that would tap into the markets to provide the necessary cover. Insurance-linked securities, ILS, were designed and later also used to cover mortality and other risks that had turned into a success story that keeps evolving. German Autobahn on a car-free Sunday. The oil crises during the 1970s were among the major economic shocks after the war. Some countries such as Germany or Switzerland prohibited driving on some Sundays to save fuel. So you can imagine people who were also constrained to drive because on some days because the fuel prices had really soared higher than expected. Then the London Stock Exchange, this was in 1983, when several industries such as Associated British Ports, AB Ports, were privatized. The big bang of the 1986 was to transform the city with a subsequent wave of mergers and acquisitions, which also heavily affected the British insurance industry. For investors, ILS presented a welcome opportunity to invest in products that were not linked to the conventional economic cycles and helped them diversify their investment portfolios. All in all, during the 20th century, the pace of globalization quickened and rising Asian and other Eastern European economies joined the competition. Insurance was in greater supply than ever to meet the growing demand in existing and new markets. But risks too were becoming more and more global. Towards the end of the 20th century, the threat of global collapse of the computer systems caused by the so-called Y2K or Millennium Bug alarmed every single computer owner across the planet and the businesses and the government organizations even more. In the end, it turned out to be a non-event. The risk had been overestimated, as had been the performance of the many new technology companies before the so-called dot-com bubble burst, causing a severe stock market crash. Yet, the largest man-made insured catastrophe of all time was to happen somewhere else and in a way that no one had foreseen. Okay, before we go there, let's brace ourselves. Let's look at how a print from the Swiss Re's Natural Perils Assessment Program in 1997, Swiss Re invested substantially in developing software tools to help calculate premiums for insurance and reinsurance against natural perils based on events, simulation, and evidence of past activity. Okay, so that still happens today, and it also invests a lot in seismology studies before how they when they're calculating premiums of various cities and all that. So this is also another lesson to some of our city authorities and nations that you can actually insure against such huge catastrophes. And in Uganda, there are so many we can mention. Of course, mostly in the Elgon region, but also we have lots of flood issues here in Kampala. Well, let's look at how other countries have emerged out of this. Let's look at the store in Singapore in December 1999 offered special deals for those worried about supply problems caused by the Y2K bug. And And this is the Swiss Re brochure on environmental protection in 1979. Liability issues for pollution had highlighted the need for the insurance industry to deal with environmental aspects. Swiss Re was among the earliest companies to provide in-depth studies of environmental impacts. And I should say this one also helped to develop how agriculture insurance is being done even today. Most especially today, because people in Uganda, it's just only about 5 years, and we hope it can grow even bigger. So the size of insured losses from natural catastrophes had grown significantly for some decades due, among other factors, to the concentration of insured risks. In the wake of Hurricane Andrew in 1992, insured-linked securities, the ILSs, became a viable addition to traditional reinsurance products. Swiss Re was and keeps being at the forefront of developing such products. And this is another example of the Rita Kaful initiative and the Sharia compliant. Then this is the Swiss Re's Rita Kaful brochure in 2010. Rita Kaful is a form of reinsurance that complies with the fundamentals of the Sharia or Islamic law. It adheres to Sharia compliant investment strategy and has an independent supervision board of Sharia scholars.
All right, thank you for the attention so far. Now, as if we have not had enough gloom and doom, now let's listen into a poor start of the 21st century. There are so many tsunamis and earthquakes that came in that rocked or challenged the way insurance was being done at that time. The liability insurances. Remember when we were starting this episode, we looked at how Time magazine wrote a very big story in 2006 that, they had stopped covering insurance in America because the liabilities were quite high. Now let's listen into more liability issues in the 21st century, right from 9/11, that was the World Trade Center attacks, and the various earthquakes.
In many ways, the new millennium began amid widespread optimism. The benefits of globalization and technological progress were having a dramatic effect on the lives of millions around the globe, and the brisk international trade signaled that the world's economy was growing. However, this optimism was soon overshadowed by fear and uncertainty that the first decade of the 21st century was to epitomize the major challenges the industry is dealing with today. Terrorism, financial crises, natural disasters, pandemics, longevity, and the changes in the regulatory environment. The terrorist attack of September 11th, 2001 claimed the lives of almost 3,000 people, many of whom worked for insurance and other financial services. In addition to the tragic loss of 9/11, ushered in a period of persistent political volatility and global security concerns. The insurance industry shouldered much of the economic burden. Insurers paid an estimated $23.8 billion, making 9/11 the most costly insured man-made disaster ever, and at the time, the second most expensive insured loss after Hurricane Andrew. Assessing the insured loss was a highly complex undertaking. Large claims were filed for a number of seemingly unrelated risks, including aviation, property, liability lines, business interruption, and life insurance. Losses and potential exposures were not confined to New York either. Airlines were grounded, restrictive security measures were implemented, and events were cancelled around the world. Insurers realized that they could no longer offer tourism insurance on the same terms as in the past. Once offered as a blanket cover with property insurance and with little consideration of price and accumulation of exposure, terrorism cover was immediately withdrawn by all but a handful of specialist insurers. The aviation and property insurance markets, however, were quick to respond with alternative solutions, and the standalone terrorism insurance market was born. The size and the complexity of losses would force companies, but also society at large, to think differently about risk. Although the stock markets remained reasonably robust in the aftermath of the 9/11, the attack brought the global economy to a grinding halt due to uncertainty of the effect of the stocks worldwide. Insurers had to contend with unstable financial markets during the volatile period. The dot-com bubble preceding 9/11 and the ensuing political uncertainty of wars affected investments of insurers and reinsurers, causing many to write down the value of their assets and reduce their exposure to equities. Some insurers and European reinsurers in particular embarked on accelerated programs to strengthen their risk management, governance, and asset management. They fortified their systems to manage accumulations of risk and liabilities in their asset portfolios and developed the first economic models. All of this occurred at the end of the soft market. Low rates and increasing liability claims had started to erode the profits of US reinsurers, and prices began growing firmer in some commercial lines. The loss of 9/11 accelerated this trend, and almost overnight, the cost of insurance went up. This hardening market for insurance helped restore profitability, but within 4 years, the market was to face a second major catastrophe. Okay, before we go to the second major catastrophe, let's look at how the New York fighters at Ground Zero 1 week after the attack. This was the day, may all these souls rest in peace, but there's a lot that changed from 2001, that was 9/11. There's a lot that came in, as you're going to see.
All right, now we have listened to how the natural disasters, these were man-made disasters that came in at the poor start of 21st century. Now let's listen into the natural disasters, natural catastrophes, and how they have affected the whole insurance game.
Katrina first made landfall as a Category 1 hurricane in Florida on 25th August 2005. 4 days later, it came ashore again as a Category 4 storm. Katrina caused massive damage to the New Orleans before moving inland to wreak havoc across southern USA. At the time, Hurricane Katrina was the most expensive catastrophe ever recorded, with a total losses of $135 billion. It has since been surpassed by the 2011 Tohoku earthquake and the tsunami, which caused $210 billion in losses, although Hurricane Katrina remains the most expensive insured loss at $75 billion. Yet, despite the magnitude of the losses inflicted by Katrina, the hurricane failed to bankrupt a single company. This was largely due to reinsurers who, over the previous decades, had specialized in providing cover for natural catastrophe risks and had done so to a much greater degree than had other organizations. Besides prompting a greater focus on analyzing accumulated exposures, the hurricane was a boon in the growing catastrophe bond market, which enjoyed its best year ever in 2007, issuing some $8.5 billion of protection. A series of large catastrophes in the past years dramatically reminded the world of the need for reinsurance cover. The Chilean earthquake in 2011, the European windstorm Cynthia, the floods in Australia both in 2011 and in 2012, the Canterbury earthquake in New Zealand, and Hurricane Sandy, and the largest insured loss in the Japanese history, the Tohoku earthquake and the tsunami, were exceptionally severe tests of strength for the insurance and reinsurance industry. Let's look at some of these. These were the monsoon rains in Mumbai 2005, the flooding they caused, and they still cause up to now. These are the floodwaters of Hurricane Katrina in New Orleans in 2005. You can see severe towns and cities were really wrecked. Then the flooded villages of southern Spain after windstorm Cynthia in 2010. Let's look at the Chilean earthquake in 2010 again. Then the Tehuk earthquake and tsunami of 2011.
Well, this being the last segment of the show, let's listen into the financial catastrophes, then how the regulation came in now to sanitize how insurance is being played at an international level. And then let's look at also the outlook, general outlook of reinsurance, and the hope we provide you to give you a sense of protection should you be in any kind of business, whether oil and gas, whether electricity, whether water. You can't expand and be a critical thinker without thinking about all these challenges and how insurance comes in to protect you.
For the global banking sector, the financial crisis of 2008 was a catastrophe. For the real economy, it brought on the most severe and dramatic decline since the Great Depression. Insurers, however, were better prepared. With a business model and regulation that is different from banks, insurers weathered the financial storm unleashed by the subprime mortgage crisis and failure of the Lehman Brothers in 2008. Overall, the insurance industry had proved remarkably resilient to the problems of other sectors. The crisis demonstrated how insurers are not exposed to the same liquidity issues as banks. Confidence in the insurance business model was reinforced. At the same time, there were lessons for the sector, namely in regulation, risk management, and investment. Government bonds, for example, for decades, a preferred low-risk investment could turn toxic very quickly as the finances of sovereign states have come under increasing scrutiny. Insurers caught in the financial storm of 2008 fell into two camps: financial guarantee insurers and those that had participated in bank-like activities such as credit default swaps and derivatives. However, the vast majority of insurers around the globe experienced few issues besides the impact of volatile investment markets. And even at that level, previous financial crises had taught them the importance of rebalancing their portfolios, which to a degree mitigated underwriting losses. To be sure, the crisis did not have other implications for insurers. It alerted policymakers and regulators around the world to the need for consistent regulatory standards and increased cooperation between supervisors. It also reinforced the need for a more robust risk management and governance, reflected in insurance regulatory reforms, mainly in Europe and the United States, which was to spread to other markets. In the US, the Dodd-Ford Wall Street Reform and Consumer Protection Act brought sweeping reform for the banking and established a federal insurance office to collect data on insurers and recommend changes to state regulation of insurance. European legislation lagged the US to some degree. In the mid-1990s, US had already adopted an overall risk-based model for capital requirements, RBC, in insurance companies. Europe at that time was still using the Solvency I system, largely based on solvency regime, which had the EEC had put in place for the insurers in 1973, and which mainly relied on defining capital requirements for insured risk. But more sophisticated risk measuring models and methods had been available over the 30-year prior, and so the Solvency II directive was drafted with a much wider scope, but also with a broader impact on insurers. This is because the cost of tighter capital requirements for the insurance ultimately fed through to products and in some cases cannot be passed on to customers. So this is an investor reading a newspaper at the private stock gallery in Kuala Lumpur, Malaysia in January 2008. You can see the dip in the investments. They were just on a sky nosedive, and that is how equities and stocks still are up to now. They are quite volatile. Although many countries around the world adopted the US type risk-based capital regulatory system, the Solvency II directive has had a huge impact on insurers worldwide, even before its pending implementation. Not only in Europe, many states outside EU are evaluating the Solvency II model with a view to adopting it for its use. In fact, the directive provides useful guidelines to setting up comprehensive enterprise risk-based risk management for insurers, but it may also prove very costly to implement. Certainly, the Great Recession also reaffirmed some of the fundamentals of insurance and reinsurance to understand the underlying risks, to challenge models that suggest the future will follow the past, and to rethink the unthinkable. Today's issues and challenges for insurers are plentiful. Aging populations, natural catastrophes, pandemics, terrorism, energy solutions, financial stability, food security, or climate change are only the top of a long list that requires attention from insurers and reinsurers. Solutions can be found in both traditional products and in financing such risks as the capital market by means of securities. In essence, the art of risk management has remained the same over the last 150 years. What has changed is the complexity of those risks, their global distribution, and their interdependence. But the many lessons that have been learned over the long history of insurance and reinsurance have prepared the industry to cope with more challenges in the future. Okay, so this is now the first EEC directive, that was Solvency I, to regulate the insurance industry. It can be Googled at any one time. Then let's look at medical advances have helped increase life expectancy, but with this good news comes new challenges in retirement refinancing. Governments, insurers, and pension funds should work together to help plan for longer lives. Swiss Re has developed funding solutions to assist the insurance industry and the pension funds in addressing this longevity exposure. So let's also look at food security. Is one of the main challenges of the 21st century. Millions of people depend on agriculture for their livelihoods, but vulnerability to weather and climate-related shocks is a constant threat to their food security and well-being. So agriculture insurance is also a solution there. So let's look at the value of reinsurance as I'll conclude this very interesting, I know sometimes boring, but it's very necessary to know where we've come from, to know where we are going. So today, insurance is an integral part of our lives. Building a house, marketing a product, driving a vehicle, all would be unthinkable without taking appropriate insurance cover. By contrast, reinsurance remains virtually unknown by the general public, even though it plays a key role in taking on risks and enabling economic growth and progress. Reinsurance is the insurance for insurers. It carries out one of the fundamental principles of insurance, namely that risks need to be spread as widely as possible. The more broadly they are shared, the more cost-effective it becomes to cover them. From the very beginning, reinsurance business was international, helping clients offset their risks across the globe. Similarly, its breadth of activity across the lines of life and non-life business let specialized insurers diversify their risks over a wider range. And through its long-standing client relationships, some dating back to the 19th century, and a third dimension has been opened up of distributing risk over extended periods of time. Reinsurers accept risks of virtually every kind, from natural catastrophes to higher mortality and motor insurance to aviation liability. These risks are transferred to them by the primary insurers, who then need to keep less risk capital tied up and write more business as a result. As the premiums paid for the reinsurance are invested via the financial markets, both primary insurers and reinsurers contribute significantly to the economy, which helps drive growth and benefit society in general. Reinsurance naturally researches risks and the nature of risk more than any other part of the financial services industry. And I have to add here that if you watch the Discovery Channel and all that, there are so many developments into mega engineering constructions in Europe and the US and Asia, because and there's a lot of research that goes into that with the funding of insurance, because at the end of the day they want to mitigate the risk as much as possible. Okay, knowledge accumulated over the centuries today is harnessed in statistics and the state-of-the-art models to better understand the risks of the 21st century. This effort directly benefits clients and society as a whole, and reinsurers are also active voice in the public discussion on risk. For addressing the big issues of our time and coping with natural perils or pandemics, ensuring large-scale projects and consumer products, and ultimately ensuring our everyday lives, reinsurance has become indispensable.
Well. I can't thank you enough for paying attention and braving all these minutes to listen in to a very intriguing story. And it's a story that we are now just trying to reframe and enhance. Many times we have been working as Ugandan insurers, we've been working at the whims of the various reinsurers, but now we are having a local insurance policy, meaning there is no company that can come into Uganda and bring an insurance from elsewhere. We have known about the local marine insurance policy. Now, at least with the history of where we've come from, we can now appreciate why we are now coming of age to do things ourselves. But this has been a serious journey of over 200 years. We have seen how it has played out. And we believe this is a movement we are beginning. We're going to reach out to other players to tell us their origin story, to tell us what they have in plan for us, what are their terms of service. We had over 40 years ago, in the 60s, insurance was taking over 2 months to be processed from their country of origin. Like in Uganda, if policies were being done in Kenya, they will take those some good time. But now it is just a matter of 2 days, 3 days, your policies are out. Now you can't appreciate that without knowing where we've come from. And this history that was commemorating also around the independence time, we felt was necessary. I've also made a blog which we have been following. You can always keep track or give your comments or feedback in the comment section of the channel below, both on YouTube and also on the blog, so that we understand where I've come from and also appreciate. If you have any concerns, if you have any, those of you who were there in that time, please give us your testimonies that time. And we know so that people can appreciate this whole industry, not the way banking industry has been appreciated. And banking cannot grow without insurance. So with these few remarks, I want to thank you again. Please tune in for this show every Sunday at 6 p.m. on New 2024 TV, and with a repeat on Thursdays at 11 a.m. and also on YouTube, of course, both on the channel of U24 and also on the channel of the Promise Insurance Show. And also give us your subscriptions, give us your comments, and also the likes, and also share with other people who can be of interest. I remain Emmanuel Safali, having brought you this special Independence episode of the Promise Insurance Show. And I remind you once again to hope for the best while preparing for the worst. I sign out.